Hello and welcome to this session. This is Farhat, in which we will discuss voluntary non-exchange transaction. Voluntary non-exchange transaction is part of the Governmental Non-Exchange Transaction Revenue Recognition series, which we've been working on. Now, in the prior session, we looked at mandated non-exchange. Here we're looking at voluntary, and I will show you the key differences between the two. Bear in mind, you have to be familiar with modified accrual as we are going through this session. Modified accrual means the revenue has to be measurable, quantifiable, and available. Available means available for our current expenditure for this fiscal year, or the funds 60 days after fiscal year end. Let's go ahead and dive into voluntary non-exchange transaction. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great, you are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
Voluntary, from the word voluntary, are agreement or transfer where resources are given willingly. This is what voluntary is. You're doing this willingly by one entity to another entity without equivalent exchange of value in return. I'm giving you something. I don't expect anything in return. I don't have to give it to you. Obviously, you don't have to accept it, but it's willingly. We can both do that. It's a one-sided transfer of value. I'm giving you something. I don't expect anything in return. I don't have to do it by law. It's not mandated by law. It's entered into willingly by two or more parties. Now, it's very important to just look at the voluntary transaction criteria versus the mandated transaction criteria just to get an idea. The mandated, when it comes to imposition versus willingness, the mandated, it's imposed by higher level government. Voluntary, entered into willingly by two parties. How about flexibility? Well, the mandated one, limited flexibility in participation or negotiation. In a voluntary, there's offer flexibility in negotiation. What do you want to do with this money? So on and so forth. Source of initiative, the mandated one, it's initiated by the provider government. Voluntary, it could be initiated by either party, and we're going to see how. Scope of participant, typically involve different level of government. Voluntary transaction, you're going to see you could involve, government and non-government entities. Compliance requirement, obviously the mandated, it's stricter because by its nature mandated, versus voluntary, it's less stringent. So what are some examples of voluntary non-exchange transaction? Grants. The federal government providing an education grant to state government or public university. Simply put, it's a grant. You do whatever you want to do with it. Use it properly. Now, can they put conditions? Sure they can, but those conditions are agreed between the two parties. Contribution, as we said, it doesn't have to be government. For example, you could be an alumni of a university, alumnus donating funds to public university to support infrastructure or scholarship. So that's also a voluntary non-exchange where a well-off individual, they want to reward their college or university. Endowment, same thing. A foundation gifting funds to a hospital to finance ongoing research. Again, you're given this out of good heart. You don't need anything in return. And that's a voluntary non-exchange transaction. Now, how about the revenue recognition, the accounting part? Well, revenue is recognized when all eligibility criteria are met, including time-related stipulations. So we still have to stick with that. And eligibility criteria often depend on factors such as the purpose, funds must be used for the intended program, or time. So whatever it is, it does not really matter. You have to meet eligibility criteria. And here you have condition fulfilled. For example, sometimes you have to reach a certain milestone, such as matching contribution. For example, a state government provide $1 million grant to a public university, specifying that the funds must be used for research within the next fiscal year. So university cannot recognize the revenue until they start with the research next year. Then the time condition is met. What should you do? Go to Farhat Lectures, look at additional resources, quiz, additional lectures that's going to help you, whether you are a student or a CPA exam candidate. Invest in yourself. Good luck and stay safe.